So now I'd like to turn things over to Dr. Andreas Park. Andreas is an associate professor at the University of Toronto, where he is the co-director of the Masters of Financial Economics program. He teaches courses on market microstructure, trading, asset prices, pricing, and corporate finance. His research covers empirical topics such as the market impact of market maker pricing, dark orders, and frequency trading, and theoretical topics such as herd behavior in financial markets and the impact of trading mechanisms. So with that, I'll turn that over to Andreas.
All right, good morning. Okay, so I'm not used to talking into microphones. I hope I'm not going to be too loud. So my name is Andreas Park. I work at the University of Toronto, and I do most of my research these days with the Canadian equity markets. Yeah.
Sorry for this interruption.
That's okay. So I can just continue talking. I do some research on Canadian markets, on high-frequency trading in Canadian markets, and I'm generally interested in how our markets work over here. My task is to give you an introduction to market structure, and in the course of it, I also want to talk about, hope to link market structure to the emergence of high-frequency trading in our markets. My objective is to do this in a balanced way so that you will see different arguments of the debate, and that you hopefully also understand what high-frequency trading is, what it isn't, that we can address some of the myths around it, and that we can have a discussion about how markets work and how markets work in modern times. Now, I should say this is a very steep task. I teach courses on market structure. That's a semester course, so some of the topics that I have here is a condensed version essentially of an entire semester at the University of Toronto for graduate students. So I hope it's not going to be too much. I know that finance is an area which is very jargon-laden, so there is a lot of words that people are not generally familiar with or that have a different association in real life compared to financial markets. And you should feel free to ask me questions either during the talk or afterwards. This is a general invitation that if you have questions, you can email me, you can call me, or talk to me here after the session. I'll be very happy to answer your questions. So we want to talk about Market Structure 101, and I want to introduce you to high-frequency trading. So let's start with the definition which is brought forward by the Security and Exchange Commission in the US. What they say is high-frequency trading, it involves employing technology and algorithms to capitalize on very short-lived information, gleaned from publicly available data, using sophisticated statistical, econometric, machine learning, and other quantitative techniques. Now that's quite a mouthful. We will try to dissect the different aspects of it during this presentation. But what you can see this goes at is that they try to use essentially statistical tools and trying to use market data in their trading analysis. Now, before we start talking about what that is, I thought it's a good idea to take a step back and look at the evolvement of markets over the last few centuries. There's not going to be a complete and absolutely accurate history description, but I want you to see that you can understand where we're going and where we're coming from. So the biggest exchange in Canada, in the United States, is in North America, is the New York Stock Exchange, which goes back to trading under the famous Buttonwood Tree in New York. The New York Stock Exchange was founded in 1792, I believe, with the Buttonwood Agreement. And what you can see is that an exchange used to be just a location where people would come together to do their trading. Now, from the founding of the NYSE, it took 25 years until they actually moved indoors. Now, speaking of indoors, here's a picture of how the TSX looked like and how trading looked like at the turn of the century. There was a large room. You can see, I have a little laser pointer here, you can see there's people. These will be the traders. In your exchange, you have people who record quotes and report prices, and there's people who do some of the admin work. Now, for many, many years, trading exchanges actually worked in the same way. You had human interaction. People had their trading at a central locale, and that was just how it was working. Now, if you go to the 80s and 90s, trading got more sophisticated. There was more technology involved. but there's still a lot of human interaction. Now, this is a little misleading because this is not an exchange. This will be a futures. So it's not a stock exchange. This will be a futures exchange. But you can see there's traders here. They're still talking to one another. There's some market makers down here in the lower area. I'm sorry, I can't really point over there. No, does that work? There will be market makers down there who facilitate the trades. And you can see, however, that technology already plays a role. Now, since the turn of the century, an exchange looks like this. So what is that? Well, this is a warehouse. It could be somewhere in some suburb, somewhere in some basement. It's a server room, essentially. And what you have is, in the middle here, you have a central computer. That is your exchange. It's a server. And these boxes here, these contain the traders. Now, nobody is caught in there, if you're worried about it. But what that really is there's servers in there who do trading. There's also gateways where trades come in from the outside. But a large amount of trading happens just in that one locale where computers trade autonomously. And so the question that you have, and that we all have, is what does that do to our markets? And so the first one that leads to is, of course, is we have, if you want to put it in wider terms, is we have the rise of the machines. So machines take a very large role, computers take a very large role in the way our markets operate these days. It's particularly prevalent in stock markets, of course, but also in futures markets and in many other markets. Now, one of the things that it does is computers can do things faster and they can do more than humans. And here's an expression of this using, again, looking at US data. This is a plot that I picked from a website called Nanex. It's a group that collects industry data. And what you see here is you have, on the bottom, you have the blue line. And the blue line is essentially the amount of trading that is going on. So these are the real transactions that you have in markets. And what you have as the red line, these are the number of quotes that are being produced in the marketplaces. Now, to give you a comparison, during the dot-com bubble, which was the end of the 1990s, when most trading was still organized by humans, we had an average in the US of 5 million orders per day. If you look at these different spots in time, we had point A here, which is about 1 billion messages per day. That was the time of the height of the financial crisis in 2008. Then pot B is when we had something called a flash crash. That was a huge event in markets. It's one of those that gave a wake-up call to many people in markets. And that already was a scary moment, and there was a lot of activity around that time. And then we have here point C, which was the time when Congress threatened, again, to have the U.S. default on some of its loans. So what you can see is you have an enormous growth of messages from 5 million a day at the end of the 1990s to about 2.3 billion, up to 2.3 billion within just a very short period of time. Okay, now, here we go. So this is really big data. This is a lot of data. So using data from NASDAQ, it's a little more impressive when you use US data than when you use just Canadian data, but let's go with the NASDAQ data, is that in the US, on NASDAQ, they have about 25 billion messages that pass through the system every day. That means it's around 1 million messages per second in a 6.5-hour trading day. The NASDAQ itself says that they have to keep about 1 petabyte of data in compressed form at any given time. So just to give you the perspective of how much data that is, 1 petabyte is 1,000 terabytes. A terabyte is quite a lot amount of data. That's about all the Netflix streaming amount, and we're talking about US Netflix, not Canadian Netflix. It is the entire DNA of the US population can be stored in that amount. And if you have 2 petabytes, that's all the amount of academic research which has been done that is in US libraries. So this is a gigantic amount of data. Right? Now, what that does is, this is one of the, if you want, externalities that are generated. An externality means an external effect, which is a cost that is imposed on on people or market participants. It's one of the major externalities of electronic trading in general that is causing people a lot of grief, if you think about it. It is so much data to process. When we talk about 25 billion messages being processed by an exchange, this is also data which goes out to traders, which goes out to the dealers, and somebody has to process. That's a large cost. So that you need computer systems that can process this data, and that's expensive. So part of the complaints that you have about the developments in markets is due to the fact that there's just a lot of data which is being created. Now, I want to be very clear that it would be a little harsh to put this on just a few people and a few entities. Many people and many entities in markets create a lot of messages and create a lot of data these days. Okay, so then apart from the data amount, there's also the speed question. So things that have changed over the last decade, if you want, is the speed at which information can be transmitted and at which trading happens and information enters markets. Now this is a plot of some random company. We don't really have to talk about what that is. And what you see here is the trading day. You see the information for a given trading day for this company. Now this is what you as a human would be able to process and observe. So you see the trading, you see how price goes up and down, and you see there's one spike in trading activity at that point. Now that's one that you can process. Here's what a computer can see at the same time. Now what you see here, these little dots, these are trades, and these bars here are changes in prices and quotes on markets. Now this episode, this bar that I showed you, has a total length of 275 milliseconds. Now does anybody want to make a guess how many times you can blink in 275 milliseconds? It's less than 2 times. The fastest time at which somebody can react to a visible stimulus, that is, there's a light flashing and you can press a button, is around 250 milliseconds. So in that time that it takes a human to react, there's a lot of activity happening. And what that essentially does is that means that people who are used to trade by themselves as humans, looking at markets and looking at prices, they will have a hard time doing that these days. Okay. So now, we have to think about what that does, and I don't want to pass any judgment on it because there's 2 sides to this development. The one side of it is that it will be hard for people to follow the business model that they used to have. On the other hand, what it means is that people have to rely on computer technology, and you may want to think about whether that's a good or a bad thing. When you substitute a human with computer technology, it's essentially what you do is you substitute often gut feeling with science, with data analysis and data-driven approach, for better or worse. Now, the question that before I go how we get there, the one thing I want to, and I can't do a talk on market structure and high-frequency trading without bringing it up, is the so-called flash crash of May 6, 2010. Now, Thomas and Peter will all agree that the flash crash looked differently in Canada than it did in the US. So the movements were not anywhere as extreme. But essentially, if you don't recall this particular episode, let me just say that within a very short period of time, when you see this gigantic drop in prices over about 15 minutes, prices in the US went down by about 7.5% and then rebounded by another 5-6%. And that happened all during a single trading day in a single moment of time, if you want. Now, it didn't take regulators a very long time to actually figure out what had happened at the time. It was a movement which originated in futures markets. There was a very large order which was supposedly to be traded over maybe a few days, was traded over just a few minutes or few hours. And it was a particularly poorly programmed execution algorithm. What triggered it was essentially a 75,000 share units futures trade at the value of around 4 billion, which was a large number in futures market, even in futures markets. And it just came too fast, and markets just couldn't process it anymore. So that was essentially the electronic version of a fact finger trade. Means that somebody just puts the finger, instead of wanting to buy 100 shares, they buy 100,000 shares or the like. I should say that while I haven't talked about what high-frequency traders are at this point in time, this was nothing which was caused by high-frequency traders as such. They were not the origin of it. The origin was a poorly executed trade which came and was entered by a human at the time. This is not to defend one way or the other. It's just that these are just the facts that as we know them so far. Now the question that you will have is, how did we end up here? How do we get there? How do we get to this point where there's so much data is generated, and what facilitated it? Well, then it is a process And there's a number of questions, there's a number of answers to that. Now, the first thing is it's just technological progress. Technology gets better, technology gets cheaper, and it is being used. Financial markets have always been at the forefront of using technology. And it's a natural thing to move from human interactions and from human-controlled behavior and trading to electronic trading. Canada was, in fact, at the forefront because Canada was the first major stock exchange. The Toronto Stock Exchange was the first major stock exchange in the world that moved to entirely electronic trading in 1997. And others eventually followed suit. Now, there's further developments. As the world globalized, starting at the opening of the East, also companies sought their capital on a worldwide scale. So as companies went out and said, well, we want to find funding, we want to find sources of funds at different exchanges, at different economies, there was the competition between trading venues. And Canada felt this particularly strongly because we are very closely connected to the U.S. You'll see on our major market that many, many companies are listed both in the U.S. and in Canada. If you think of a company like RIM or BlackBerry, before they collapsed, they were a majority of trading, of Canada's trading, but most of their trading actually happened in the U.S. And they sought funding from the U.S. because it's a bigger capital market. So now, what is the natural reaction when you see a markets having to compete with one another? The way you have to think about exchanges is the traditional way was that they were owned by their members, meaning that there was a bunch of firms that owned the exchange, and they had this exchange basically to facilitate their activities. So if you want, there was a mutual entity. Now, when you have a mutual entity, a non-for-profit entity that is facing outside competition, the natural thing to think about is, well, we think, believing in capitalism, that the best way to respond to a competitive pressure is by having a competitive company. So what happened was a process which is called the demutualization of stock exchanges, meaning that these stock exchanges went from companies which were owned by members to fully for-profit organizations. What that does, it does change the business model, or rather, let's put it like this, they actually had to develop a business model. And it means that you have to think about, as an entity which has to work for its shareholders, of how you can generate income. And one of the ways how exchanges, and there's actually three ways how exchanges generate income. Number one is listing fees. Number two is data fees. And number three is trading revenue, coming from fees that they charge people to use their trading platform. And so exchanges have an interest and have an incentive in principle to increase the amount of trading out there at their facilities. Now, that's not necessarily a bad thing, and most of the brokers will be very happy if that happens because trading is also beneficial for them, give or take, on the large scale. So now the next step is, I know I'm dwelling very long on this slide and there's very little movement, but just bear with me for a little more so that you understand the history of this. So now when you have for-profit entities as local exchanges, well, what's the next thing that you have to think about? You basically have monopolists. So you have in Canada, you have the TSX only. You have in England, you have the London Stock Exchange. In Germany, you have Deutsche Börse. These are essentially monopolies for the trading in their local economy. Do we like monopolies? Well, we might, but how do we deal with monopolies? There's two ways how you can deal with them. Number one is you regulate them very tightly, or number two is you allow for entrance to come, to allow for competition. And so the natural way, the way we think about it in a capitalist society is that we like to have competition. We like to invite competition. And that was also the way how markets developed in general. It started in the US. I don't want to get too much into the details of how the competition was developing on different fronts there. But it essentially worked down to that the regulators allowed and changed their regulations to allow entrants to come into the market. And so in Canada, we have the national instrument rules. In the US, we have some major regulations which are called National Market System and Alternative Trading System, if you need to have any reference on that. So what that allowed was entrants to come into the market. And as you put entrants into the market, you see that trading becomes increasingly fragmented over different trading venues. So that's the natural reaction of having competition for trading in markets. And now, once you have fragmentation, this is a possibility, opportunities for traders to use the fragmentation and the different trading venues to their advantage becomes possible. Now, I want to say some things here about this note, so that this fragmentation, is splitting up of market, and the development of multi-markets is not exclusive to any particular jurisdiction, but the way it works in Canada is very different from how it works in the US. And I would imagine that many of you follow US news as much as you follow Canadian news. And the way markets work in the US is very different from the way, well, it's not very different, it's similar to the way the Canadian markets work, but the American markets are, let's put it in frank terms, thoroughly screwed up. So the Canadian markets are much less fragmented and work in a much more persistent manner, and we have regulations in place which ensure that our markets are more transparent and more open. Now, so this is a general word of warning, but I just want to show you how our markets look like. So until, let's say, 2008, almost 99% of trading in Canada was on the Toronto Stock Exchange. In 2008, there was in 2007, the first competitor came up, which was called Pure Trading. Mark will talk about that a little bit. In the end of 2008, we had a major alternative trading system enter the market, which was Alpha. Now, this is how markets look in 2013. This is the most recent data available. The Toronto Stock Exchange takes about 59% of the dollar amount traded in Canada. Then we have an entity called KAIEX. This is not a household name, but it's an alternative trading venue which uses NASDAQ technology. It accounts for about 20% of trading. The former independent trading venue Alpha takes about 10%. They're now part of the TMX group. And then you have a large number of smaller venues that also have their fair share of trading. So now these are not a large number of different venues. In the US, you have about 14 public venues and about 50 invisible venues that are very opaque, and I don't want to go into the details of what it is that they do. But in Canada, we have a degree of fragmentation which is important, and I will explain in a few minutes of how that interacts with the possibility of high-frequency trading. But it's not really that bad. Okay, so I want to give you some statistics now, because I'm still at the process of establishing some facts about high-frequency trading. There's two sources of information that I have for the prevalence of high-frequency trading. The first is our regulator IROC's HOT study. So it's a study that they did in order to understand how high-frequency trading in Canada works. And the second source is some work that I did with Katja Malinova and Ryan Reardon, which is based only on the TSX composite securities. It's an academic study, so we do things a little differently, and we have different objectives. So the first thing that we notice in our data is that in 48% of the transactions over our sample period, high-frequency traders were involved on the passive side of transactions. Okay? So they are pretty important one way or another for our markets. Then the next thing is that they send about 82% of all the orders. And we don't actually have all what we would think of our high-frequency traders. So this number could actually, this is a lower bound rather than an upper bound. So they are very important, very prevalent in our markets. However, and one of the things that we learned from IROC's HOT study is that the way high-frequency traders operate is not uniform. It's not homogeneous. For instance, they are very active in ETFs, which are exchange-traded funds. It's a particular type of security. This is not companies. This is a collection of companies, if you want. They are, however, very inactive on stocks that trade at prices below $5. And they're very inactive, or they have relatively low activity in ventures, which I understand is where most of your companies will be listed. So in other words, while the amount of high-frequency trading in these composite securities is quite big and quite prevalent, for some of the smaller issues, the amount is not quite so big. So, and it's important to understand that too. Now, finally, and I want to bring this up early and just have a discussion about this, is there is a discussion generally about what high-frequency traders do to market volatility. So there's a research study by RBC, Royal Bank of Canada, which says that from 1996 to 2008, volatility in Canadian markets has increased, and since 2008, it stays at a high level. So that is the measure. They use a particular measure of intraday volatility for that. There is, I wouldn't say a counter study because it looks at a different market, but it's an academic study by Joel Hasbrook, which says essentially that the volatility that we observe at the price level at 50 millisecond intervals, which is what is relevant to high-frequency traders, is about 4 times the variance that is justified by fundamentals of a corporation. So it is larger. There's a large volatility in these quotes. So there's something else going on than just information about fundamentals entering prices. He also finds, however, that average market volatility has not increased between 2001 and 2011. What has changed, though, is the style of volatility. And this, in some sense, links back to what the RBC study finds. In the following sense is that in early years, volatility came mostly from spikes in prices, sudden spikes in prices, and they were always there. So this is not something which is prevalent to HFTs. We always had spikes in prices, and even those may not have been justified by any fundamental. Whereas in later years, where we have a prevalence of computerized algorithmic trading, the oscillations come from stronger oscillations but at low amplitude. So it means that you have a lot of fluctuations, but they don't actually have a high movement. All right. So before we go on to talk about what high-frequency traders are, how they operate, and what they do, I want to just take a step back and just spend a few minutes talking about the role of secondary markets, so that's the public markets where your companies are traded, and why we actually care about them. So why should we care about market structure? Now, it all starts with an entrepreneur who has an idea, and therefore who needs funding. Now, where does the funding come from? Now, there's essentially 4 sources of funding that you can think of, or that I could think of. You may have probably a better sense of where you get your money from. You can ask friends and family. So now that's a little bit of a risky thing, and you put your friends at risk. You can also go to the bank, but you will all know that it's pretty difficult to get a bank loan, given the mandate of banks, to make loans which are secure and secured, where you have some collateral. It will be, I imagine, quite difficult for a resource company to provide collateral when all that you have is a plan to drill or to dig in a specific area, and you have an excavator, and that's probably it. You can go to private markets then, angel investors and so on and so forth, and you can try to get your company and get funding from private markets. That's usually pension funds and the like that have, or hedge funds that have some money that they can invest, or you can go to public markets. Now, let's think about a second for the difference between the private and the public market. So what are the cons of the public market? You will know about them better than I do. You have reporting requirements. You have regulations that you have to abide by. So that creates costs for you, creates headaches for you. And you have pesky investors that you didn't invite to come along, and they, harass you during meetings and the like. I hear that you all know that. Now, what are the pros? Well, the pros are actually not so much related to you, but rather to your investors. You will have a larger investor base that you can access. And what is much more important, however, is not that you can access the larger investor base, but that your investors can access that larger investor base. Because what that means is essentially that if they want to get out of your company, they can easily find somebody else. They can go to a public market and trade out of your shares. Now, when I say easily, that easily is a little bit of an overstatement. It may not be quite so easy. But in general, there's the idea of that there is a mechanism by which they can exchange the holdings in your company for another company. So why is that good for you? Well, that's good for you because the investors in your company have more flexibility. And as they have more flexibility, at least in principle, it should be easier for them. They should require you to work less hard in some form and create a lower rate of return. They should be satisfied with lower rates of return. In very loose terms, this is the main advantage why we like public markets. Now, just as a, because I'm a finance professor, so I can put one equation I had to put on here. So if you think about the required rate of return, which is what you have to develop, which you have to give back to your investors, you can take as a rule of thumb is an opportunity cost. Now, that means that your investors could also put the money in a savings account as opposed to giving it to you. You have to deliver a risk premium because companies are riskier than a savings account. And there's transactions costs. So people have to take into account how much it costs them in the future to sell your securities. The way I like to explain it to my students is say, well, suppose you're a house flipper, right? You want to buy a house, you pay $500,000 for it, you want to sell it for, say, $700,000, and you want to put some money in for renovations. You have to make sure that after you put in your renovations and after you pay your realtor, you still get a profit out of it. And our realtor fees are not negligible. So these transaction costs matter. And they matter to the point where they affect your rates of returns that you have to deliver to your investors. Now, you can also argue that the risk premium is important and that the way markets operate will affect the risk premium that you have to generate, and we're going to talk about that a little bit later. But the general part is how we think about what high-frequency traders are doing is, or what general markets are doing, and where a very well-functioning market helps is if the future transactions costs are kept low. And these transaction costs do depend on the quality of the secondary market. Rule of thumb, the more liquid, in whatever way you want to define this, the market is, the lower will be these costs, and the less hard you have to work in order to get funding from your investors. All right, so now that I've done this little slideshow, let's talk about high-frequency traders and what they do. Okay, so now the general strategies of high-frequency traders can be separated, and I'm very bold here, into 3 different categories. I may miss some out and so on and so forth, and I'm coming about the specifics of high-frequency trading in a second. But generally, there's 3 different types. The first is liquidity provision, the second is what's called statistical trading, and the third is what's called trading the tape. Okay? Now, what does liquidity provision mean? Liquidity provision means you're trying to make a market. So that means what they're trying to do is they're trying to benefit from the ability that the price at which at which investors will buy a share is the ask price or the offer price. It's higher than the price at which the same investor could, at the same moment in time, sell the shares, which is the bid price. So the idea of a market maker is to benefit or to profit off this little gap, which is called the bid-ask spread. So that's now. That is not actually a strategy in itself which has been invented by high-frequency traders or by algorithmic traders. It has obviously been around forever. If I go back to the point of the slide where I showed you the buttonwood tree, where people traded under an exchange, I have 2 minutes for that slideshow, is the New York Stock Exchange had a very interesting figure which was called the specialist. It was a single unit, a single person who would organize all the trading in a security. Now, the origin of that is that at one point, one of the traders had broken his leg, so he couldn't move around the place. So he sat at one spot, put his foot up and said, for today, I'm going to buy and sell and do all the trading in a particular security. And that's what he did. And he tried to profit off the buying and selling for that security in such a way that he would always buy low and sell it high and profit from this bid-ask spread. This is how this particular market-making model developed over time. And this is one of the strategies that is currently used often by high-frequency traders. Now, I put another strategy on there which is referred to as rebate trading, and I bet that both Thomas and Peter have an opinion which is opposing on that topic. And just a little bit of background, what rebate trading refers to is the following. In addition to the difference between the price at which a market maker buys or sells, exchanges provide incentives commonly for people who provide liquidity. So these are people who are willing to sell at the ask price and buy at the bid price. So those guys, those people, those entities that provide market-making services. So the exchanges pay small amounts of money for that activity. On the order of for 100 shares that are being traded, they pay about 30 cents. And if you make sufficiently many of these transactions over the day, you can try to make a living. Now that is a new thing of modern markets, which I want to emphasize at this point. Okay, let's talk about some of the other things that high-frequency traders do. They do something called statistical arbitrage. What that activity essentially refers to is you try to take information from other securities, from other markets. For instance, simplest example is a stock RBC trades in the US and trades in Canada. If there's any discrepancy in the price between the two exchanges, you try to profit from that by making a trade or by moving prices. There's also some activity referred to as technical trading. It's been around forever. If you ask me, this is really voodoo science. But so as a finance professor, this is something I don't quite understand. But it basically is about trying to detect some trends and trying to detect some movements in markets and trade on that with an algorithmic trading strategy. The third part is what's referred to as filter trading and momentum trading, or trading the tape in general terms. The idea there is you take information from other sources, including from futures markets, including from indices, and also things like social media and the like, and you try to understand whether or not there's any market movements, and you can predict market movements. It also involves the analysis of public data, and what you're trying to do is you're trying to analyze whether by some patterns in the data you can detect whether or not, say, a very large order will hit the market. When a large order hits the market, it moves the price, and moving the price is an opportunity to, well, it's costly for one side of the market. It's everybody who trades against the large order may lose on that basis. It is also a profit opportunity because if you can detect that the large order comes in, somebody say wants to buy, if you can move the price from 10 to 11 and you can sell to that big entity at 11, you're making a profit off that. Oh, okay, my screen is gone. Okay, I have 10 minutes. Perfect. Okay, so now the first question that I just want to very briefly argue is this rebate trading or this market making by high-frequency traders something which benefits the market, yes or no? We have done some work on this. I'm going to just show you a simple graph, which is that's not good. All right. Since we're not... Yeah, I can actually explain it without the slides, and I can also yell very well. What we did at the time was, our regulator put in a fee, which at the time was, at least for a very short period of time, was considered to be potentially quite expensive. And what happened as a consequence of which, those traders which generate a lot of orders as part of their strategy, what essentially happened was the following, is traders that generate a lot of quotes and messages, which we generally think are at least part of those are high-frequency traders, reduce their activities very substantially. They reduced their activities by about 30% in absolute terms. And as a consequence of that, at the same time, transactions cost measured by bid-ask spreads took a jump upwards. So what that tells us is that, at least on that, to some degree, there is a service provided by this market-making activities. Now, I want to be very clear about it that this service which is provided, measured by the bid-ask spread, does not include other costs that are generated, such as high message traffic and the cost of processing those. I don't have any data on that. You can't say anything about that. But this activity and this evidence is pretty clear on that front. All right. Now, on my slides, the next thing that I want to talk about, the next thing that I will be talking about is what is special to high-frequency traders. So the very important message that I want to bring up is these three strategies that high-frequency traders engage in, most of them are not new. They are not special to our modern market. Those are activities that have been around for a very long time. As long as there has been interlisted securities, so where companies trade in Canada and the US, there has been the ability to do statistical arbitrage. In fact, many people, and you can argue that some of these activities are very beneficial to markets in the sense of that they ensure that markets are efficient. When there is a price misalignment, what people do is they try to take advantage of it. They try to move prices in such a way that they reflect the fair value of it. Now, why is that important? It's important so that people like you and I, or uninformed investors, when they go to the market, they can at least have some hope that the price that they will receive is a fair price. Right? That's the basic idea of this that underlies this. Now, the next thing I want to talk about, which is unfortunately not on the screen, but however is what is special about high-frequency traded. Yeah, this one's good. No, this one. Yeah, this one. It is what's called latency arbitrage. And essentially what that is about is that you're trying to exploit speed differentials. And that really is what the core of high-frequency activities are, is that you make use of speed. Yeah? Now, there's essentially two ways how you can categorize taking advantage of speed. The first one is how you access information and how you access different exchanges and different trading platforms. And so that part is something which is new to our markets, which include multiple different trading venues. Oh, very good. All right. Okay, so essentially there's two ways how you can benefit from speed. The first is when you can try to generate differences in speed differentials between different trading venues. And the second one is you can try to improve your local technology, the one that is close to the exchange. So I want to be fast about this, but there's a lot of movement in that, and there's a lot of investments that have been made in that sphere. So for instance, there is a new data line, which is being discussed to be put across the Atlantic at the cost of, I believe, $300 million to shave off 5 milliseconds of delay. So that is one data line is 5 milliseconds faster than the next. That is a very tiny advantage, but in a sphere of markets where you have high-frequency advantages, this is very important. The second one, so other examples are that so what these traders are good at is really that they're trying to use as much technology as they can to have a speed advantage. Now the second part is that you try to do it at the exchange level. So what people do at the exchange level is that they already put their computers close to the exchange, and that in the process of it, thank you. So that's the second point that I have, in the process of which they're trying to be faster there. So they're trying to have faster computers. It started with, instead of using hard drives, they put everything on the RAM, and when the RAM was not fast enough, they used graphic cards, because graphic cards are so much faster than the RAM that you can have in your computer. Now, one has to say this, is that at that front, exchanges actually go through some pain to ensure that there's a level playing field. How do they do that? Well, for instance, when I showed you this picture of the server room, the cables going from the furthest server from the exchange to the closest are all the same. And this is actually some activities that have been going on for a long time, that exchanges try to make sure that there is no advantage which comes at their location in terms of the speed. Oh, I should say for online viewing only? Or? People can see online. Okay. All right. So the exchanges did go through some pain to make sure that this works out well. Just again, some history background. Initially, exchanges were reluctant to go out and allow this co-location services where people could put the servers in the server room. Now, what happened at NASDAQ was the following: is they didn't tell anybody where it is, and the TSX doesn't tell you also where it is. It's an undisclosed location somewhere in the suburbs of Toronto, and Markham, I think. Sorry, Nancy. So, but the NASDAQ did, they didn't tell anybody where the servers were in New York. And then at one point, they realized that the building where they had their own servers, the rents were going up. So what happened is that the trading industry put servers all over town, and they pinged the servers. So they sent messages and looked at the response time, and then tried to triangulate in which building the server was located. So that is something that you cannot prevent from happening, in other words. Now, the one thing I want to say, though, the issue that people have with this latency arbitrage is that it essentially boils down to what I call to my students is nana economics. And so the way it works is essentially like this, is if, say, Peter and I would have the same information, the same public information, we'd probably take the same decision, right? But if I have the information 5 milliseconds before him, I can take advantage of it and then turn to him and say, nana. Now, this is something which causes some frustration among people in markets, and it's something that we should look out for. And it's to some degree important that, the fact that there's such a huge investment being made means it is something that matters. And in order for that investment to pay off, you have to extract rents. The money has to come from somewhere. And it leads to frustration with people if people think that they would have taken a different decision had they been just a little faster. So that is something that is a challenge for markets. It's a challenge, however, it has always been a challenge in markets. This is, again, not something that is new. It's just the extent at which technology is being leveraged to do this is new. The speed at which these realizations of differences in nano economics work, that's new. So here's a pretty picture of the data lines. I just want to quickly, I know that I'm almost at the end of my talk, but I just want to quickly show you to some degree how trading works and what some of the problems are and how you can benefit on this. So the way it works is here we have a number of exchanges. We have the TSX, we have Alpha, and suppose a very large order hits the TSX. So you have a trader here, sends an order to the TSX. Now, if that order, the way our markets work is if that order is so big that it would consume all the orders that have been posted at the best price. Suppose there's, like maybe 1,000 shares posted at the best price on the TSX, and this order is for 10,000 shares. Then if this liquidity is consumed and other markets process these, have better prices or have the same price, then what the TSX has to do is they have to forward the remaining trade to other venues. They have to send it to Alpha, which currently is a very short line. They have to send it to, or they have to maybe have to send it and notify the kayaks and other venues where these things have happened, where trading can also occur. Now, if you're a high-frequency trader and you learn what happens on the TSX, you may have the ability to outrun the information which is being broadcast from the TSX to any of the other venues and do something at the other venue which would then possibly disadvantage the trader elsewhere. So that is at least the way it is being explained, and this is the way one can think about these latency arbitrage or latency games, if you want. Now, I'm sure Thomas has an opinion on that, and I'm sure Peter has the opposite opinion on that. But this is basically the mechanics of how these games and how latency advantages work. Okay, so I think I am at the end in general. Now, I hope I gave you some overview of how markets work and what high-frequency trading is about. I hope I also didn't scare anybody with showing you big data and all those things. Now, let me just, instead of going through these discussion points because we don't have enough time to go through them, let me just say a few things which are contentious and which are things one has to think about when we think about high-frequency trading. The first one is there's this gigantic amount of data which is being produced. Now, that's problematic for everybody. Everybody has to make investments. However, these investments come at a fixed cost, more or less. So small brokers have to invest a very large amount in order to keep up with the markets as they are. Now, in principle, we're all, this is a capitalist society, and if people do not have the ability to keep up, that's their problem. Usually, that's the way we think. However, a broker does many different things, and so when the trading services that they have to provide as part of their general dealings get much more expensive, that impedes on the remainder of the business. And I think this is the concern that many of you have, is that when you have your small brokers which help you raise funding, have to overspend in a particular area without any tangible benefit, then that's a problem for you. So I think this is one of the issues that we have to think about, and that one has to generally think about of how the gigantic cost of data can be mitigated. And I think there's actually people are thinking about it, but it requires a certain evolution of thinking. And the second thing is how can we make sure that there is a reasonable level trading playing field on markets, so that the importance of latency, the importance of speed advantages is not leading to the point of too strong a redistribution of benefits from trading. Because you know how this goes. When you're on the playground, you play with other kids. I have little kids when they play on the playground, and if there's too much nana going on, then the kids just don't play anymore. And that's something which is a concern, of course. All right. Should I take questions? Probably not.
Probably not. Unless does anyone have a question? There also will be an opportunity at the end for questions. It's a lot of information, and there's going to be a lot more. So.